Legal 117, this is your podcast for weeks 5 and 6. And as promised, we're moving into more of the substantive areas of administrative law, or the things that you may find yourself dealing with in a law office, either as a specialty or that you come across because of various needs of your clients or issues related to your clients in many areas of the practice of law. And that could be family law, it could be criminal. It could be any areas of the practice law. But then there are also many of you who will end up doing a lot of business work or working for a corporation or business entity. We have students who are working, or former students who are working at the corporate law offices of the Walmart Corporation in Benton, Arkansas, the world headquarters of Walmart, in Caterpillar, all over the place, not just locally. State Farm Insurance, and so big, huge mega corporations, and then others like our local RLI insurance company, which has been an awesome employer for our graduates. So, plus all sorts of positions in lots of different areas in corporate or business environments, from risk management to monitoring work comp or disability claims, or working in human resources, or working for lawyers in-house for general counsel, OSF, and other places. All over the place. So it's important stuff to know, and it does transcend every area of the practice of law, and it's just something you should know. If you've had legal environment of business, you may be familiar with this already, or if you've worked in this area or worked in this area, you have some general knowledge. Or if you have a business degree or background, you have some of this knowledge. There's as you know from doing the reading, and hopefully you've done the reading I've asked you to do. If you haven't, stop, and as always, go back and do the reading, because what I'm going to say, it's going to make a lot more sense if you've actually done the reading. If you've done the reading, you know that there are essentially the following alternatives for for-profit business organizations, generally in the United States and especially in the state of Illinois. So the first one, the easiest to set up, is a sole proprietorship. It has to be owned by one person or a married couple, and if there are more than one owners, the business automatically becomes a general partnership unless there's some type of entity that's created. It doesn't have to be anything formal. There may be licensing requirements, depending on the business or the purpose of the business. There may be things that you have to do regarding state, local, or federal government administrative agencies regarding the type of business you're involved in. But from a general business perspective, you don't have to file anything with the Secretary of State, say, as we will talk about in greater detail when we talk about limited liability companies, corporations, and some of the partnerships. A general partnership is when we have two or more persons or other types of entities. A partnership doesn't have to be people. It can be businesses. Two businesses, a limited liability company or a corporation or both, can enter into a partnership for a particular purpose and form another entity. Now, a limited liability or a corporation may generally but not always be a partner unless a partnership agreement or some applicable law or regulation, states or otherwise, has some guidance. But if you and your friend wanted to start a partnership, you really don't need anything in writing. You'd be wise to have all your terms in writing, to have a partnership agreement, but it's not necessary. You would want to write something up, and that doesn't have to be formal. You could write it up on a cocktail napkin sitting in a bar. If you both signed it and it set out the terms, and those terms would be enforceable. That document would be enforceable. Document used loosely. That's a general partnership, and again, we'll get into greater detail on these in coming weeks. Limited partnership It's the same as a general partnership except for formation, liability, operational, and tax differences. A limited partner's liability, so you have people that are doing the actual work of the corporation. They are doing the day-to-day work of the corporation. And a limited partner is essentially an investor, and their liability is limited to their investment so long as they don't involve themselves in the day-to-day operations. If they do involve themselves in the day-to-day operations and there's some sort of issue, it's possible that their liability is extended beyond their investment. So if there's a general partnership, you could have a limited partner involved in that general partnership, but their sole purpose is to invest money and receive something back. Now, as I said, depending on the state, there are different expectations and there may be different liabilities, including tax and otherwise. To a large degree, limited liability or limited partnerships, general partnerships, as we knew them prior to the early 1990s, have been replaced by the limited liability company. Now, the limited liability company may be owned by one or more persons or other entities. The owners are called members. As we'll see when we get into this, it's really semantics. It's different terms, but a limited liability company, to a large degree, walks like a corporation, talks like a corporation, operates like a corporation. It just has some advantages. It's a little less regulated and it's a little easier to operate. And so the limited liability company, for that purpose, replaced many of what were traditional partnerships in the past, especially in the professional services arena, but also with family-owned businesses and things like that. Now, a corporation let me back up. So limited liability company, you'll see when we get in there are two types there as well that coincide a little bit towards what we discussed with general partnerships and limited partnerships, in the sense that there's member managed and manager managed, and depending on the type, you could have some limited liability for the owners, for the members, if they are not participating in the day-to-day operations. Their liability might be limited to their investment. Again, we'll get into these in much greater detail. This is just the introduction. Now, corporation, which is a term most people are familiar with, most of us think of corporations as some of those entities that I mentioned earlier where our graduates are working. We always tend to think of like the huge corporations, the ones that seem to insert themselves into our lives in various ways. The reality is that the majority of business entities, period, and even corporations are small. They're smaller entities. And that's still the case in the United States. A corporation can be owned by one or more persons. A corporation can be owned by one person. It can be owned by one or more persons or entities. Those owners are called stockholders or shareholders. From a tax standpoint, it may be a subchapter C or a subchapter S corporation. The difference with a corporation and why people tend to make the assertion that it's complicated and all of that and more expensive is that you're taxed as the corporation, and then you're also taxed on your personal gain or income from the corporation. Except for the federal tax treatment of these entities that I just described, and depending on the industry, most of the other aspects and issues in their formation, legal effect, and conduct are governed by state law. State laws will vary, creating perhaps the biggest reason to seek the help of a professional like us. Now, for additional research materials, consider checking out the IRS Business Structures Guide or the Small Business Administration's Outstanding Business Type starting page. And those resources will give you some more information. Which of the type of entities, as you know from your reading, suits the client's needs is going to depend on a lot of different factors. All of these things must be considered to ensure that the business needs are met. So we want to look at the complexity of formation of the entity and the complexity of keeping the entity compliant with laws and regulations. A sole proprietorship or even a general partnership may be formed without any formal documents, although this isn't advisable, especially in a partnership situation. Accounting, reporting, and preparation and filing of tax returns may be significantly simpler or more complex depending on the form of the business that's intended to be used. The number of owners always plays a factor. The more owners, the more formal you're going to want things, the more regulated you're going to want things. The more owners and their level of involvement, certain entities are going to be more advantageous for more owners situations than single owner situations. Also, in some cases, certain owners may wish to be passive investors or have limited authority, responsibility, and liability, and essentially just be putting their money into the business. You'll see that a lot in transition of farm businesses, small family-owned businesses locally. If you get into this work, you'll see that more often. What type of owners are allowed, i.e., whether the owners must be individuals or may be business entities, is going to depend on what type of business you choose to form or we direct people as the best options. You always want to check with the state. Determine what businesses or where the business is located. The state where the business is located, doing business in or doing most of its business in would be the place that you'd want to really look at. Liability is always a concern. Liability to customers, to vendors, to other third parties. Some of the types of businesses that I listed provide a limitation of liability to owners and prevent unlimited access to personal assets of the owners by creditors. For instance, a corporation. If it's truly a corporation, it's not set up to be some sort of sham pass-through, which then the corporation fails and the creditors can come after the person or the owner. If it's a true corporation, the idea is that one of the benefits and one of the reasons that people say, well, it's worth the other cost or the other difficulties or additional things you have to do, is that your liability, your personal liability, is limited to whatever the corporation has as assets or your investment in that corporation. You don't have that protection if you're a sole proprietor, per se. Another typical consideration is whether or not you want to attract capital, attract investment. And the ability to attract capital and the capital structure of the business, the number of investors and the extent to which your business is capitalized by equity ownership, investment versus debt or lending ownership, is going to be an important consideration in the choice of which type of entity you choose. In other words, if you're looking to be capitalized by equity, you're giving up some of your ownership control and some of the profits. If you're capitalized by debt, by loans, well, then you're risking that you're going to have to pay those loans back. So I guess it depends on the terms and the interest rate and all of that, and how much control you want to give up. Definitely something that plays into how people set up a business. Sometimes it depends on the industry in which the business is engaged. Some generally heavily regulated industries, they may want to operate in a more formal manner to be a corporation, as an example. So like banks, liquor establishments, various types of franchise operations, just because of the complexity of the industry or how much it's regulated. There may be business management preferences. Do you intend for all owners to have a say or a vote in the business operations, or do you want to limit or even prevent management participation by some of the owners or investors? Is the business going to be managed by non-owners? I mentioned the manager-managed LLC or corporation where you hire a management staff. The answers to those questions are going to impact your entity choice. Tax considerations is always one of the most crucial, most complex areas of analysis when it comes to the entity choice. Each of those types of entities I described may bring substantially different tax results to the same transaction or occurrence. These potential differences arise in various areas, including the nature, timing, amount of recognition of income or loss, the deductibility of expenses, allowable accounting methods, the retention of earnings in order to meet future operational requirements, the tax rate applied, the possibility of double taxation, the availability of tax treatment of fringe benefits such as pension, health, life insurance, application of payroll taxes, self-employment tax, and the amounts, methods, and tax treatment of compensation of the owners. These differences may occur at both the federal and state level. Now, I'll put in something that I'll mention probably more than once over the course of the next few weeks. When it comes to this area, the type of accounting, any of the financial aspects, so tax, financial, accounting, liabilities from the tax, financial, and accounting realm, I always, and I believe that most lawyers, unless they are a CPA, will do the same, always required someone who wanted me to set up a business entity to go to a qualified business accountant, a CPA, preferably from a reputable accounting firm with experience in doing this exact thing, to get an opinion letter based on all those factors that we just discussed and how that individual thought, and especially for tax considerations, this business should be formed. It should be formed in a corporation, an LLC, partnership, whatever. We, I, you, me, our legal staff would make an analysis based on other factors, on liabilities and other things. And so there can be a legal analysis and an accounting analysis. Now, most of the time, those jive. Sometimes they may not, but most of those times they jive. But essentially, I'm not someone who can make those considerations, and that's not our area of expertise. And we are going to have the opinion of someone that our client is going to pay to tell them. And then, in all likelihood, we want to, after the business is formed, be the business's lawyer, and that accountant wants to be somehow involved as that business's accountant going forward. So definitely we do not step into that realm, and keep that in mind. Finally, the ease of transferring ownership and the tax consequences of such transfers to third parties, purchasers, or heirs is also always a consideration. All right, and that's the example of where we come in. So we know the law. Those of you that have wills, trusts, and estates, and those of you who will have it in the spring, will know what that is going to look like. And based on the business or the business type chosen, it may not be so easy. It may create issues with the estate, depending on the estate planning of the individual. If you're a sole proprietor and you die, more likely than not, your sole proprietorship dies. Okay? Those are the things that we focus on. Now, this is just a partial list of the various factors that need to be analyzed. The details behind these differences can be complicated, and it's critical to understand the client's needs and intent very clearly. We need to sit down with the client and find out not only what they think that their intent is and where they think the business is going to go or where it is right now. A lot of times people will come to you and they've already started doing business, but they have nothing formalized. One time I had these, I shouldn't call them kids, but they're kids. They're college kids. They're at Bradley. This was in the 1990s. Bill Clinton was the president. And they had started this skateboard online. There was no Facebook, Instagram, Snapchat, cell phones that had screens, smartphones, etc. But there was an internet, and they had started to sell skateboard related things online. They eventually, and for a time, became one, as the internet grew and the access grew and social media started to come into play, one of the largest such entities. One of the kids was a pro skateboarder, and they just got together and started doing this, and they started making inroads to countries outside the U.S. to manufacture things, and they made some dough. But when we sat down, they were more interested in just getting the stuff and selling it. And it took a while to get them to understand how complex it could be very quickly. And after consultation with an accountant and getting that all set up, we went with the LLC for their initial formation. Eventually, they were so big that they became a corporation, then eventually bought out by somebody else. You have to see what the possibilities are beyond what your client sees as the possibilities. Our job is to foresee the good, the bad, and the ugly. And so we have to analyze things from that perspective. So this is just a partial list, and we'll discuss some of these matters in more detail in future weeks when we break down the different business entity types. I asked you to take a look at the Illinois Secretary of State's Department of Business Services. It serves as the approval and record-keeping office for various business types in Illinois. And as you now know, this department is a place to go to for having certain types of businesses approved to do business in Illinois. They don't necessarily have to be formed here, but if you're doing business in Illinois, certain types of business, or actually doing pretty much any business in Illinois, you need to be registered with the Secretary of State's Department of Business Services. It provides a place to find applicable documents, filing requirements, and the law, and it receives and keeps records necessary to form and then do business in Illinois for corporations, LLCs, and limited liability partnerships. It's not intended to overregulate people or anything like that. The simple truth of the matter is if we do not have this sort of service, then we can't track who is doing business in Illinois. And from a liability perspective, when one of those businesses creates a loss for someone, we want to be able to track who is doing business to get to that entity. My old liability days when I was doing civil liability cases where people were severely injured or killed, that was imperative. When there were big losses, you needed to be able to find out who was responsible for that entity, who was going to provide a defense for and have the money to pay out on those claims. It's about responsibility. In the assignment for this week, I asked you, why you thought the office seems to be tasked with the formation and record keeping of corporations, limited liability companies, and limited liability partnerships, but not sole proprietorships or general partnerships. And the answer to this question is twofold. First, sole proprietorships and partnerships having far less formal requirements in formation and often being far more fluid in most every other aspect, including continuity. Businesses die with the owner. They're difficult to track. And second, the liability of businesses stays with the owner. So we don't have to worry in those circumstances as long as we can find the owner. That's who's liable. Corporations, LLCs, and LLPs offer an option to limited liability of the business owners, and when a business owner's liability is potentially limited, there's a public interest in regulating or being able to locate those businesses. And as I said, from my experience, I can assure you that it can be equally difficult to collect a judgment from a sole proprietorship or a corporation. And the concept of being able to find the owner isn't always beneficial to collecting a debt or a judgment from that owner in any business form. But where the business or the form of the business specifically allows a limitation of liability, the state has an interest in having information on file as to who's responsible for actions of that entity. Next week, we'll review the four general types of businesses with a view towards how each can be regulated. But for this week, if you were aware of these types of businesses, you have a little more knowledge. And if you weren't, you have a lot more knowledge. Either way, trust me, it's going to serve you well. We are past the quarter mark of the semester, approaching week 8, and I always say pay attention because especially in the fall semester, you get to week 8 and then those last 8 weeks fly. They fly in the spring semester too, but important things to be aware of. If you're going to register for spring classes, that information is going to be coming out around the 1st of October, and you need to start getting your appointments. And the schedule will be released and start enrolling people usually in the first week of November. But then we have that Thanksgiving interruption, and very quickly, boom, end of the semester. We have a lot to cover in this class, and all your courses, you have a lot to cover. So keep your focus, stay aware, keep your energy, keep on working, and if you need me, you know where to find me.